Thank you very much for joining us. Pleasure having you on ET Now. What does India look like to you given the various global factors that are playing out at this stage in the world today?
Oh, India still looks very, very exciting. I mean, I think while there are clearly some difficulties emerging from North Africa and the Middle East in terms of geopolitical tensions, the long-term demographics of India, the enormous infrastructure investment that's taking place and that will take place over the next several decades, I think make India a very, very exciting economy in which to invest.
In the short term, though, could this Middle East story and what's happening in Africa turn into quite a snowball that could possibly hurt most of the recovery that we're seeing?
I don't think anybody really knows. I mean, you can certainly paint a dramatic picture, particularly if oil prices were to spike well beyond where they are today. I don't really think anybody knows. I do think, though, that there is coordinated global attention to seek to avoid the most dramatic outcomes that would arise, and you're seeing both within the North African and Middle Eastern region actions being taken by the stronger countries and concerted attention from the major nations of the world to avoid that. So I'm hopeful that that won't be too much of a problem.
If one were to just lift this away, because it seems to be a bit of an aberration in what was looking like a recovery story, are you convinced by the signals coming out from the United States, the so-called recovery there?
I think the US is very, very interesting. Yes, it's very clear that consumer confidence is turning, that economic activity is picking up a bit. However, there's still a bit of a drag from the housing market. State finances, municipal finances, indeed government finances have some consolidation still to do, and unemployment is staying stubbornly high. So I think it's a bit of a mixed signal, but the actual economy and consumer confidence within the economy are doing well, and I think that's very, very powerful for the global economy.
Would you then say in some ways you are factoring in what could be a potential jobless recovery rather than one which could eventually create some employment there?
I think one of the greatest challenges that all nations are facing is that while profitability is improving and those in jobs are feeling more secure and better off, it's very difficult to create the jobs that the economies would like to create to deliver to those that have been unfortunately put out of work. And of course everybody now in a globalized world is competing for the same employment opportunities. So I think that it is a difficult position for unemployment for the next couple of years.
And does Europe then make for any different picture? Because again there we've got either stories of bailouts that are still working their way into the system. Interest rates continue to be fairly low, and there is no kickstart manufacturing story barring for what's happening in Germany.
I think Europe's better than people give it credit for. Yes, there are one or two countries that have got some debt issues to work through, but given the scale of Europe as a whole and the commitment that has been shown to solving this on a collective basis, I think Europe's well capable of solving this.
But even as you say that, do you think at some stage or the other we will continue to see the whole issue of, let's say, banking bonuses, regulatory issues, some of these play against what is the recovery in today's Europe?
I think one of the positives that's going to come out of this whole aftermath of the financial crisis is a much better understanding of what the role of the financial system is and what the role of banks within the financial system should be. And that will cause reflection as to the social utility of banking, what we do, how we benefit society through providing finance and safe haven for savings for both individuals and corporates. And there will continue to be proper governance and public inspection over the role of banks, including compensation and structure, and that's inevitable, and I think we have to understand that and respect that.
But you have at various points come out pretty hard on some of the levies on the banking sector back in the UK, and you have been pretty open about this subject. Do you think that regulation has probably gone a step too far and it could then strangle what is being seen as the green shoots of recovery?
We're always very open, and I hope that regulation won't strangle the green shoots. But I think it's important that people speak up and say, let's be careful we don't go too far. I mean, the point we were making on the levy is that the particular levy that the UK has imposed covers our entire global balance sheet, not just, as other nations have done, the domestic balance sheet. And that kind of creates an additional cost of having a multinational banking group in the United Kingdom. And you know, if that's the policy objective, then we need to understand what the implications of that could be. It's an additional cost for our shareholders, which is why we said that to the extent that the levy is moderated or removed at some point, then we would add the money saved to our dividends.
Okay, I'm going to come and discuss HSBC in just a bit. I want to get a couple of macro issues sorted with you, which is one, that do you think that the banking sector will have to live with a low interest rate scenario and at the same time be troubled by what is becoming high costs of funding across the world? Is that something that looks like a recipe towards disaster?
I don't think it's a recipe for disaster. I think it's quite likely that we will live with a lower interest rate environment than we had expected to a couple of years back, and in many respects that's going to be one of the supports to the economy. I think that the regulatory reform on liquidity is going to put pressure on deposit raising and put the price of deposits up, which will either be reflected in lower returns to shareholders or increased cost of intermediation. At the end of the day, banks are only intermediaries, so we either make less money, which means that society pays through lower returns, or we charge more for our services, which means society pays through higher costs. I mean, the system is purely an intermediary. But
what is the worst case scenario banks should be prepared for there in Europe?
I think I think the most realistic worst case is a period of very low credit growth and low interest rates and therefore fairly stagnant profits. That would be the worst case.
Have you in any ways kept aside the potential possibility of further bailouts in Europe? Do you think that's something that's a matter of past now and there couldn't be any more struggle in the banking system in the European markets today?
I think it's very unlikely that we'll see anything of the scale that took place in 2008. I don't think it's right that anyone can say never again could circumstances arise where action has to be taken to resolve a failing institution. I think a great deal has been done by governments and indeed by banks to ensure that there is a better mechanism to wind down institutions in difficulty at a great deal less cost than was seen in 2008. And I think that the circumstances that were around then have largely played through, so I think it's less of a risk today than it was then.
And in that respect, Basel III that's being talked about now is something that you think is a positive step given the circumstances or not? Could it actually, again, cripple some amount of movement that we're seeing towards positive growth?
No, we welcome the Basel III reforms. I mean, I think that there's no question that when you look back, a number of the capital weightings were just wrong. The liquidity that people were running with was too low. So the reforms that are taking place under the umbrella of Basel III are absolutely directionally right. I think there's a little bit more to be done on the calibration in a number of areas as we get experience as to what the impact might be on the real economy. But there had to be reform and the industry had to restructure, and that's underway today.
But the timing of it, could it have a, sort of a restrictive consequence for the supply of lending?
It could do, but that's why I think there's a good dialogue going on at the moment between the central banks, governments and indeed the industry as to what the implications on credit formation might be, and therefore to use the tools that exist within the framework to moderate that.
Have banks come to terms with the idea, especially in the post-slowdown period, that legacy assets have to go, there's no way to sort of let them be around, and that process is probably towards its fag end now?
It's certainly well through, and I think, yes, the sort of structured assets that were created in the mid-2000s, I think, will not appear again ever, or not for a very long time, and never in the volume that they did then.